Question 28 is asking us to calculate the value of inventory to appear in the consolidated statement of financial position at 31st of December 2004. So the normal point here is that most of our assets and liabilities in our consolidated SFP will take account of both the parent and the subsidiary's assets in full. In terms of inventory, the main adjustment that we'd expect to see is for any unrealised profit. And so if there has been any intergroup trading with items still sat in inventory at the end of the year, we would need to go and calculate this PUP adjustment. So in this case, looking at the detail, it tells us that during the year to 31st December 2004, S sold goods to P for 120,000 at a markup of 25%, and that half of those goods remain in inventory at the year end. The balances on each of their individual statements then are 525,000 for P, 435,000 for S. So now we just need to go and actually calculate this entry here for PUP. So 120,000 is the value of the goods sold, but only half of those are actually left in inventory. To work out the profit element, we need to be sure that we're dealing with either markup or margin, and in this case it's a markup we're dealing with, a cost plus figure. So to get back to the profit element, we need to multiply this through by 25 over 125. If it had been quoted as a margin instead, we would have just taken 25% of this figure. But here, if I do that calculation, it'll give me a value for my unrealised profit of 12, and once I deduct that from the two parts of inventory across the two companies, it should leave me with an answer of 948,000.